You know what's fascinating? While everyone's been watching gold hit record after record, silver just did something it hasn't done in over 40 years, and the people who understand what this means are moving fast. Really fast. Let me paint you a picture of what's happening right now in the precious metals market. Because this isn't just another rally. This is different. And if you're holding cash, or if you've been sitting on the fence about precious metals, what I'm about to show you might change everything. Silver just crossed $66 an ounce. Now, if you're not in this market, that number might not mean much to you. But here's what you need to understand. Silver hasn't been at these levels since the Hunt brothers tried to corner the market back in 1980. That's 45 years ago. And back then, it took a literal attempt to buy up the entire world's silver supply to push prices that high. This time, it's happening naturally, through pure market forces. And that should terrify anyone holding significant cash positions. But here's where it gets really interesting. Gold isn't just participating in this rally. Gold is leading it. We're talking about prices that have shattered every previous record, every single one. And when you dig into why this is happening, when you really look at the mechanics behind these moves, you start to realize this isn't a bubble. This is a repricing. A fundamental repricing of what these metals are worth in a world that's changing faster than most people realize. Let me tell you about something that happened recently that most people missed. Central banks around the world have been buying gold at a pace we haven't seen in modern history. Not just buying it, accumulating it like their lives depend on it. And here's the thing that should make you sit up and pay attention. These aren't small countries. These aren't nations on the brink of collapse making desperate moves. These are major economic powers, countries with sophisticated financial systems, countries with access to the best economic minds in the world, and they're all doing the same thing. They're converting their dollar reserves into physical gold. Now, why would they do that? Why would central banks, institutions that have access to information you and I will never see, suddenly decide that holding paper currencies isn't good enough anymore? What do they know that the average person doesn't? The answer is actually pretty simple when you think about it. They're watching the same thing you're watching. They're seeing the money supply expand at rates that would have been unthinkable just a few years ago. They're seeing debt levels that can never be repaid through traditional means. They're seeing a global financial system that's held together by confidence and little else. And they're making a calculated decision that physical assets, real assets, are worth more than promises on paper. But here's what makes this moment so critical. It's not just central banks anymore. The institutional money is starting to move. The big players, the hedge funds, the family offices, the people who manage billions of dollars for the ultra-wealthy. They're looking at the same data, and they're reaching the same conclusion. And when institutional money starts flowing into a market, especially a market as relatively small as precious metals, prices don't just rise, they explode. Think about the math for a second. The entire gold market, every ounce of gold ever mined in human history, is worth somewhere around $15 trillion at current prices. That sounds like a lot until you realize that's less than the market cap of just the top few tech companies. It's a fraction of the global bond market. It's a rounding error compared to global real estate. And now imagine what happens when even a small percentage of global wealth decides it needs to own physical gold. The supply simply isn't there to meet that demand without massive price increases. And silver? Silver's market is even smaller. Dramatically smaller. The entire above-ground silver supply that's available for investment is worth maybe $50 billion. That's it. That's less than what some individual billionaires are worth. And unlike gold, silver gets consumed. It gets used up in industrial applications. Solar panels, electronics, medical devices. Every year, billions of ounces of silver are used in ways that make it unrecoverable. It's gone forever. And while demand keeps growing, supply has been stagnant or declining for years. So, when you see silver hitting these levels, when you see it breaking out to prices we haven't seen in decades, you're not watching speculation. You're watching a supply and demand imbalance that's been building for years, finally expressing itself in price. And the people who understand this, the people who've studied previous precious metals bull markets, they know what comes next. They know that when silver really starts moving, it doesn't move in a straight line. It moves in ways that seem almost impossible until they happen. Let me tell you a story about what happened in 2011. Silver started that year around $30 an ounce. Nothing too crazy. Steady uptrend, but nothing that would make headlines. Then something shifted. The momentum changed. And in just 4 months, silver went from $30 to almost $50 an ounce. A 67% gain in 16 weeks. People who had been accumulating silver for years suddenly saw their positions double. And the people who waited, who thought they'd buy on a pullback, watched in disbelief as the price just kept climbing. But here's what's different about right now compared to 2011. Back then, we didn't have the kind of monetary expansion we're seeing today. We didn't have central banks around the world simultaneously devaluing their currencies. We didn't have the geopolitical tensions we're seeing now. We didn't have major economic powers actively working to create alternatives to the dollar-based financial system. All of those factors are in play right now. All of them are pushing in the same direction. And that direction is higher prices for hard assets. Now, I want to talk about something that doesn't get discussed enough in mainstream financial media: the paper market versus the physical market. Because understanding this distinction is crucial to understanding where prices are headed. When you look at gold and silver prices, what you're usually seeing is the price on the COMEX. That's the futures exchange where gold and silver contracts are traded. And here's the thing about the COMEX. It's mostly paper. It's contracts that represent gold and silver, but the vast majority of those contracts never result in physical delivery. They're settled in cash. It's a paper market built on top of a physical market, and for years, that paper market has been the tail wagging the dog. But something's changing. The physical market is starting to assert itself. We're seeing tightness in physical supply that the paper market can't ignore anymore. We're seeing premiums on physical metal over spot prices that indicate real demand, real scarcity. And when the physical market starts to dominate price discovery instead of the paper market, that's when things get really interesting. Think about what happened in the nickel market recently. For those who don't follow commodities closely, there was a massive short squeeze in nickel that forced the London Metal Exchange to actually halt trading and cancel trades. Cancel trades that had already been executed. Why? Because the physical market reality didn't match what the paper market was pricing in, and when that disconnect became too large to ignore, the entire system nearly broke. Now, I'm not saying we're going to see trading halts in gold and silver, but I am saying that the same kind of disconnect exists. There are far more claims on physical metal than there is actual metal available to deliver. And as more people wake up to this reality, as more investors demand physical delivery instead of paper promises, that disconnect is going to have to resolve itself. And it's going to resolve itself through higher prices. Let me give you some context on what's driving this from a fundamental perspective. Industrial demand for silver is at all-time highs and growing. The solar industry alone is consuming hundreds of millions of ounces per year, and that demand is accelerating as countries around the world push for renewable energy. Electric vehicles use significantly more silver than traditional cars. The electronics industry, the medical industry, the defense industry, they're all consuming silver at increasing rates. Meanwhile, silver mining production has been essentially flat for years. The easy silver has already been mined. The high-grade deposits have been depleted. What's left requires more energy, more capital, more time to extract. And at the prices we've seen over the past few years, many silver mining projects simply weren't economical. Companies stopped exploring for new deposits. They stopped developing new mines. And now we're seeing the consequences of that underinvestment. This is what's called a structural deficit. It's not a temporary imbalance that will correct itself quickly. It's a fundamental mismatch between supply and demand that takes years to resolve. And the only way it resolves is through higher prices. Prices high enough to incentivize new production. Prices high enough to ration demand. Prices high enough to bring recycling online at scale. But here's the thing about structural deficits in commodity markets. They don't resolve themselves smoothly. They resolve themselves through price spikes, through volatility, through moves that seem excessive until you understand the underlying dynamics. And we're in the early stages of one of those moves right now. Now, let me shift gears for a moment and talk about something that's relevant if you're thinking about your retirement security. If you're sitting on a significant retirement account, 6 figures or more, there's something you should understand about how gold IRAs work. I put together a comprehensive guide that breaks down the mechanics, the tax implications, how to move funds without penalties. It's in the description below. No pressure, but if you're concerned about currency devaluation, if you're worried about the long-term purchasing power of your retirement savings, it's worth understanding your options. The guide covers everything from custodian selection to storage requirements to the specific IRS rules you need to follow. Check it out if that's relevant to your situation. All right, back to what's happening in the market right now, because there's another piece of this puzzle that's absolutely critical to understand: the geopolitical dimension. We're watching the emergence of a multipolar world. For decades, the global financial system has been built around the dollar. Countries held dollars as reserves. Commodities were priced in dollars. International trade was conducted in dollars. And that gave the United States enormous power. The power to sanction, the power to print, the power to export inflation to the rest of the world. But that system is being challenged in ways it's never been challenged before. You're seeing major economies working to create alternative payment systems. You're seeing bilateral trade agreements that bypass the dollar entirely. You're seeing the BRICS nations, countries that represent nearly half the world's population, actively working to reduce their dependence on dollar-based finance. And at the center of all of this, you're seeing gold. Gold is the one asset that every central bank recognizes. It's the one asset that doesn't depend on any government's promise to pay. It's the one asset that's been money for thousands of years across every civilization. And as the global financial system fragments, as trust in paper currencies erodes, gold is reasserting itself as the ultimate form of money. This isn't speculation. This is observable reality. Look at what Russia did after being cut off from the SWIFT payment system. They immediately moved to back their currency with gold and commodities. Look at what China has been doing for years, quietly accumulating gold while publicly downplaying its importance. Look at what India, Turkey, Poland, Hungary, and dozens of other countries are doing. They're all moving in the same direction. And here's what that means for prices. When central banks are buyers, when they're accumulating and not selling, that removes supply from the market permanently. Central banks don't trade. They don't sell when prices go up. They accumulate for strategic reasons, for monetary reasons, for reasons that have nothing to do with short-term price movements, and every ounce they buy is an ounce that's not available for private investors. Now, let's talk about what this means for you, because understanding the macro picture is one thing. Understanding how to position yourself is another. If you're holding significant cash positions right now, you're making a bet. You're betting that the purchasing power of that cash will be maintained. You're betting that inflation will remain under control. You're betting that the monetary authorities have everything under control. And maybe they do. Maybe this all works out fine, and cash is the right place to be. But what if you're wrong? What if the people who are moving into hard assets right now, the central banks, the institutions, the ultra-wealthy, what if they're seeing something you're not? What if they understand that we're in the late stages of a debt-based monetary system that's reaching its mathematical limits? Because here's the uncomfortable truth that nobody wants to talk about. The debt levels we're dealing with, both government and private, they can't be repaid through traditional means. The numbers are too large. The interest payments alone are becoming unsustainable. And there are really only 3 ways this resolves itself. Default, which would be catastrophic. Austerity, which is politically impossible. Or inflation. Inflating away the real value of the debt by devaluing the currency. And if you understand that inflation is the path of least resistance, if you understand that's the politically expedient solution, then you understand why hard assets are repricing higher. Because in an inflationary environment, in an environment where currency is being deliberately devalued, the things that can't be printed become more valuable. Not in nominal terms, in real terms, in terms of what they can actually buy. Gold at current prices isn't expensive. It's cheap relative to the money supply. It's cheap relative to government debt. It's cheap relative to the total amount of financial assets in the world. And silver? Silver is even cheaper on a relative basis. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing, but it's still well above historical averages, which means silver has room to outperform gold, potentially by a significant margin. Let me give you some historical context on what happens when silver really gets moving. In the 1970s, silver went from around $2 an ounce to $50 an ounce, a 25 times increase. Now, I'm not predicting that kind of move, but I am saying that when silver enters a bull market, when the fundamentals align and momentum builds, the moves can be dramatic, far more dramatic than most people expect. And we're seeing the early signs of that kind of move right now. We're seeing silver breaking out of multi-decade consolidation patterns. We're seeing it outperforming gold on a percentage basis. We're seeing physical premiums expanding. We're seeing delivery delays. We're seeing all the signs that typically precede major moves higher. But here's what you need to understand about timing. Nobody can tell you exactly when the next leg up will happen. Nobody can tell you if we'll see a pullback first or if prices will just keep grinding higher. What I can tell you is that the setup is there. The fundamentals are there. The technical patterns are there. And the smart money is positioning accordingly. Think about it this way. If you wait for confirmation, if you wait until everyone agrees that precious metals are the place to be, you'll be buying at much higher prices. You'll be buying after the move has already happened. The people who make real money in markets, the people who build generational wealth, they position themselves before the crowd arrives. They do their research, they understand the fundamentals, and they act when the risk-reward is still favorable. Right now, the risk-reward in precious metals is about as favorable as it gets. You're buying assets that have thousands of years of history as stores of value. You're buying assets that central banks are accumulating. You're buying assets that are in structural supply deficits. You're buying assets that are tiny relative to global financial markets. And you're buying them at a time when monetary policy is explicitly inflationary. What's the downside? That prices pull back temporarily? That's not a downside if you understand the long-term thesis. That's an opportunity to accumulate more at better prices. The real downside is being wrong about the direction of the monetary system, being wrong about whether currencies will maintain their purchasing power. And given what we're seeing, given the trajectory we're on, that seems like the much bigger risk. Let me tell you about something that happened in Weimar Germany that most people don't know about. When the hyperinflation really got going, when the currency was collapsing, there was a brief period where the government tried to stabilize things. They introduced a new currency backed by real assets. And for a moment, it worked. People had confidence again. Prices stabilized. But here's the thing. The people who had converted their savings into hard assets during the crisis, they were the ones who preserved their wealth. The people who held paper currency, even the new stabilized currency, they lost everything when the next crisis hit. I'm not saying we're headed for Weimar-style hyperinflation, but I am saying that the principle is the same. In times of monetary uncertainty, in times when the rules are changing, hard assets protect you in ways that paper promises can't. And that's really what this comes down to. Protection, preservation, making sure that the wealth you've accumulated, the savings you've built up over years or decades of work, that it maintains its purchasing power, that it's there when you need it, that it can't be inflated away or devalued by policy decisions you have no control over. Gold and silver aren't just investments, they're insurance. They're the ultimate form of financial insurance against monetary mismanagement, against currency devaluation, against the kind of systemic risks that most people don't even want to think about. And like any insurance, the time to get it is before you need it, not after the crisis has already started. Look at what's happening in the bond market right now. Yields are moving in ways that suggest investors are losing confidence in the long-term value of fixed income securities. Look at what's happening in real estate markets, where prices have become disconnected from fundamentals in many areas. Look at what's happening in equity markets, where valuations are stretched by historical standards. And then look at precious metals, which are still well below their inflation-adjusted all-time highs from the 1980s. Where's the value? Where's the safety? Where's the asset class that's positioned to benefit from the trends that are already in motion? The answer is becoming increasingly clear to anyone who's paying attention, and the people who are paying attention, the people who understand monetary history, who understand market cycles, who understand the difference between nominal prices and real purchasing power, they're moving now. They're not waiting for permission from financial media. They're not waiting for their financial advisor to tell them it's okay. They're looking at the data, they're understanding the implications, and they're acting. Because here's the final piece of this puzzle that ties everything together. We're not just in a precious metals bull market. We're in the early stages of a complete repricing of hard assets relative to financial assets. We're watching the unwinding of a 40-year trend toward financialization. We're watching the pendulum swing back toward real things, tangible things, things that have intrinsic value beyond someone's promise to pay. This is bigger than gold and silver. But gold and silver are the purest expression of this trend. They're the assets that have no counterparty risk, no default risk, no political risk. They're the assets that have survived every monetary system collapse in history. And they're the assets that are positioned to preserve and grow wealth in the environment we're entering. So when you see headlines about gold and silver hitting new highs, when you see prices that seem expensive compared to where they were a few years ago, understand what you're really seeing. You're seeing the market repricing these assets for a new monetary reality. You're seeing the early stages of a move that could dwarf anything we've seen in recent decades. You're seeing the smart money positioning for what comes next. The clock isn't just ticking, it's accelerating. The moves we're seeing in precious metals aren't the end of this trend, they're the beginning. And the question you need to ask yourself is simple. Are you positioned for what comes next? Or are you going to watch from the sidelines as the greatest wealth transfer in modern history unfolds? Because that's what this is. A wealth transfer. From people who hold paper assets to people who hold real assets. From people who trust the system to people who understand its limitations. From people who wait for certainty to people who act on probability. The final lap has started. The race is on. And the finish line is going to look very different than most people expect. Make sure you're on the right side of this trade. Make sure you understand what's at stake. And make sure you're not the person looking back in a few years wondering why you didn't act when the opportunity was right in front of you. The data is clear. The trends are clear. The setup is clear. What happens next is up to you.